Hi, good morning, everyone. Thanks for joining us this week on our Phillip Security Research morning call for the 1st of August 2022. Today, we have quite a few stock counters that we'll be discussing as well as the FOMC meeting highlights and Singapore Weekly for our macro sector outlook. Without further ado, I'd like to hand over the time to Ambrish to talk about Microsoft. Thank you.
Thank you, Sean, and good morning, everyone. So last week, we published Microsoft's 4Q 2022 update report, and the report was titled Azure Deals Supporting Growth. Next slide, please. Overall, the results were in line with our expectations. FY 2022 revenue and PATMI came at about 99% of our forecasts. So Microsoft's total revenue, they increased by about 12% year on year to $51.9 billion in the fourth quarter. And this was the slowest quarterly growth rate since 2020. Also, PATMI was up just about 2% year on year, and this is mainly because the margins contracted due to the investments in cloud engineering, FX headwinds, shutdowns in China, as well as a challenging market for the sales of personal computers. Moving on to the positives, first of all, Azure continued to drive Microsoft's earnings. In the fourth quarter, Azure and other cloud services revenue, they grew by about 46% year on year on a constant currency basis. And this significant growth, it was mainly because of the large and longer term Azure contracts, they grew. And the strength in Azure and continued shift to the public cloud offerings, they helped to drive the overall cloud revenue and the intelligence segment revenue. They grew by about 20% year on year to $20.9 billion in the fourth quarter. Secondly, Microsoft Office 365 is a key growth driver for the productivity and business process segment. The Office 365 commercial revenue, they grew by about 15% year on year in the fourth quarter. And this was mainly because the number of subscribers, they grew by about 14% year on year, due to the ongoing momentum in small and medium businesses, frontline worker offerings, as well as the average revenue per user they expanded due to the stronger adoption of higher end E5 license. E5 license, it is basically a productivity app that protects customers' data from cybersecurity attacks. With respect to a third point, the number of E5 users, they increased by about 60% year on year, and it now accounts for 12% of the Microsoft Office 365 commercial installed base. And this upgrade to the higher end tier, it was basically because of the robust demand for advanced security capabilities due to the rising cybersecurity attacks. Moving on to the negatives. First of all, FX headwind, it had a material impact on Microsoft's earnings. As the US dollar, it further strengthened in the fourth quarter, it created a headwind of $595 million total revenue. And this was about 1/3 of the revenue growth rate, or 4% impact on its PATMI. Secondly, production shutdowns in China and slowing sales of personal computers, they led to a $300 million headwind to Windows revenue. A more personal computing segment, it accounts for about 1/3 of total business, and we believe that it is back to the pre-pandemic matured stage. And as a result, the other two segments, the intelligent cloud and the business processes, they will take a couple of time to build the overall group revenue. Additionally, Microsoft, it has significantly reduced its business operations in Russia due to the ongoing war. And as a result, the company's operating expenses in the fourth quarter, they increased by about $126 million. And this was mainly related to bad debt expenses and asset impairments. Moving on to the outlook, the FX headwinds, they are likely to continue in FY 23. So for the first quarter, the Microsoft, they have highlighted a 5% revenue headwind. The company also mentioned that Azure revenue, it will be sequentially lower by just 3% on a constant currency basis. This was much better than feared. And the reduction in Azure revenue, this is mainly because of moderation in consumption. However, this consumption headwind, it would be offset by strength in 100 million and 1 billion multi-year Azure deals. For FY23, Azure expects double-digit revenue and operating income growth. This was despite the worsening of macroeconomic environment. And also the operating margin for FY23 is expected to be flat at about 42%. This is mainly because the boost from lower depreciation due to extension of asset life, this will be offset by the negative foreign currency impacts. So moving on to the valuations, we have reduced our target price to $332. This is mainly because we lowered our FY23 revenue and PATMI by 3% and 4% to account for the deteriorating PC market as well as the negative foreign exchange impact. However, overall, we still believe that the robust demand for Microsoft's cloud offerings will support revenue growth as well as the reopening of the economy. It will continue to drive user growth for Office 365 commercial. I would now like to pass on to Jonathan for update on Meta Platforms and Alphabet. Thank you.
Thanks, Ambrish. So I'll start with Meta. They released their second quarter 22 results last week. Next slide, please. Okay, so overall, their quarterly revenue was in line with expectations, although they did miss slightly on earnings. In terms of their first half 2022 performance, their revenue and PATMI is about 43 and 42% of our full year forecast. In terms of revenue growth, actually revenue declined about almost 1% year on year. But apologies, it should be second quarter 22, but it actually grew 3% year on year in terms of constant currency. So onto the positives, we currently see Reels, which is their short form platform, driving positive user growth. In terms of overall user growth, they have monthly active people. This number grew about 4% year on year. And with ad impressions also growing 15% year on year. So one of the key drivers for revenue growth right now, or for user growth right now, sorry, is this short form video platform, sorry, that I guess it is kind of the trend nowadays. We're seeing this with Reels, that it's growing about 30% quarter on quarter compared to the first quarter of this year. What we're also seeing is that business messaging is starting to be a potential lever of revenue expansion. So they have this product within business messaging called Click to Message, where if a user just clicks on this particular link, it opens up a direct chat with a business, a small business, connecting both parties instantly. And it's proving to be quite popular amongst SMEs in Brazil and Mexico and in other emerging markets. So currently this business has about 1 billion users and is growing year on year at a strong double-digit pace. So we think that once the company is able to expand these like business messaging products into more regions and more countries, they'll be able to drive revenue expansion and stronger growth just because of the uptick and the popularity that these kind of products will bring to small businesses. In terms of earnings, their earnings missed slightly, mainly due to higher than expected expenses, which increased 22% year on year. At the same time, headcount also increased 32% year on year. And this was mainly due to hiring in tech functions, which were above expectations because most people are actually slowing down their hiring. However, Meta did mention that it expects headcount growth to slow for the rest of the year, and even into next year as well. The second negative is that the company actually issued a very soft third quarter guidance, mainly due to continuing weakness in advertising, as well as a 6% FX headwind from a strengthening US dollar. So they expect revenue to be in a range of 26 to 28.5 billion US dollars, which represents about a 6% year-on-year decline. So moving on to the outlook, like I mentioned earlier, the company guidance is for -6% year-on-year growth. However, they also did lower their total expenses guidance to $85 to $88 billion. Oh, sorry, to a range of $85 to $88 billion US. Currently, that transition to Reels is ahead of schedule, with more than $1 billion US in annual revenue for the last 12 months. The company is also focusing quite significantly on artificial intelligence and machine learning to deliver a better ad experience for both users as well as advertisers, particularly in the as they try to deal with headwinds from the Apple privacy changes that were made in the second quarter of last year. So we reduced our full year 22 revenue and PATMI by 5% and 10% respectively, on the back of slowing revenue growth, as well as FX headwinds. But we still maintain a buy with the lower target price of $221 US. Our previous target price was $231 US. Next slide, please. So I'll cover Alphabet next. They also issued their second quarter 22 results last week. So like Meta, their revenue was in line, but they also did miss quite significantly on earnings. Their first half 22 revenue and PATMI is at 45% and 36% of our full year forecast. In terms of revenue, they delivered about almost $70 billion, which represents almost a 13% year-on-year growth, or 16% in constant currency. And this is kind of bringing you back to pre-pandemic levels when it was growing at the high teens rate. In terms of operating margins, this was down 3% year-on-year to 28%. In terms of positives, their second quarter 22 revenue kind of met estimates for its top line. Like I mentioned earlier, this growth was driven by its services growth, which grew 10% year-on-year, as well as cloud growth, which grew 36% year-on-year. The company also remains on track to hit our full year FY22 forecast, even amidst their near-term FX headwinds. Second positive is that cloud continues to push ahead. It continues to be Google's fastest growing segment, growing at 36% year-on-year. Although this has slowed slightly from 45% in the previous quarter, it's still on a really good path. Growth was driven mainly by continued corporate demand across Google Cloud Platform and Google Workspace, as more and more companies decided to leverage on cloud's artificial intelligence and machine learning, as well as cybersecurity capabilities. So Google also remains focused on working towards profitability for its cloud segment, has been reducing its losses quarter on quarter. In terms of the negatives, there was a higher than expected unrealized loss in debt and equity investments, which was hurting the bottom line. So their margins was about 23%, which contracted from 30% last year. And this was due to almost $4 billion fluctuation in equity investments. So if we normalize PATMI, if we take out the equity investments, PATMI for the first half of FY22 will be equal to 43% of our full year forecast. Our second negative is that a weaker macroeconomic outlook and strengthening headwinds, FX headwinds are expected to continue. So in the second quarter, Google actually saw some pullback in spending by advertisers across all verticals and industries. I expect this to continue in the third quarter, reflecting a somewhat uncertain macroeconomic environment. At the same time, a strengthening US dollar is expected to provide a 3.7% FX headwind on growth. So in terms of outlook, we expect a moderating growth in third quarter of 22, mainly due to the weaker macro environment, especially because most of Google's revenue comes from advertising, and advertising demand right now is fairly low. We do expect cloud to continue remaining resilient through the increasing corporate demand, as well as its backlog for its services. We expect YouTube Shorts, which is its short form video platform, to continue its strong user engagement. So So YouTube Shorts is currently recording more than 30 billion daily views and has over 1.5 billion users per month. So we think that YouTube advertising will continue to be an important tool for advertisers and should generate strong revenue growth moving forward. In terms of valuation, we reduced our FY22 PATMI forecast by 10%, and we also adjust our total expenses upwards slightly. We maintain a buy with a reduced target price of $139 from $144. So that's it for Alphabet and Meta. I'll pass my time now on to Glenn for UOB. Thank you.
Thanks, John. So for UOB, our title is boosted by higher net interest income. Now moving on to the next slide. So just a brief update on the results, the second quarter results. Second quarter earnings of 1.1 billion were in line with our estimates due to higher net interest margin and healthy net interest income growth. The first half PATMI is at 43% of our FY22 forecast. The net interest income was up 18% year-on-year from a NIM increase of 11 basis points to 1.67% and loan growth of 8% year-on-year. The fee income fell 1% quarter-on-quarter, while other non-interest income was up about 170% quarter-on-quarter. Management is guiding for single-digit loans growth with higher NIMs, stable cost-to-income ratio, and slightly higher provisions. UOB has guided for NIM to expand at 9 basis points each quarter and to reach an exit NIM of 1.9% by the end of 2022. We also estimate the second half net interest income to jump 22% year-on-year. Now moving on to the positives. For the first positive, the net interest income grew 18% year-on-year, and this was led by continued loans growth of 8%, while the NIM improved 11 basis points to 1.67%. The loans growth quarter-on-quarter was mainly from term and housing loans, while year-on-year loan growth was broad-based across geographies as businesses regain momentum. UOB has lowered its guidance for loans growth from mid to high single digit to mid single digit loans growth for FY22. The second positive is that other net interest income increased 6% year-on-year and 170% quarter-on-quarter. The year-on-year increase was due to the strong momentum for customer-related income as hedging demand rose, while the quarter-on-quarter increase was on the back of customer-related growth and normalization from the first quarter's short-term impact on hedges and unrealized mark-to-market on investments. For the third positive, the fees were stable but fell 2% year-on-year, and this is despite loan fees growth of 3% quarter-on-quarter and 10% year-on-year, and record credit card fees as customer spending increased with borders reopening. However, this was partially offset by lower wealth and fund management due to subdued market conditions. UOB has now lowered its guidance for fee income growth from high single-digit growth to low single-digit growth for FY22. For the negatives, there are two negatives. The first negative is that total allowances increased 20% year-on-year to 173 million, resulting in credit costs increasing by 2 basis points to 22 basis points. This was mainly due to specific allowance increasing by 20% year-on-year to 166 million. The total general allowance for loans were prudently maintained at 0.9% of performing loans. UOB has also maintained its credit guidance, cost guidance of 25 basis points for FY22. The second negative is that new NPA formation increased by 83% year-on-year to 661 million, mainly due to a major but non-systemic corporate account. Resultantly, the NPL ratio rose by 0.1% to 1.7%. Nonetheless, the second quarter NPA coverage is at 91% and unsecured NPA coverage at 185%. Now for the outlook, UOB's PATMI should continue to grow in 2022 on the back of stabilizing margins, stronger fees, and lower provisions. We expect the net interest income to expand 14% year-on-year. We expect credit costs to come in below the guidance of 25 basis points. And management has said that as they are being conservative, they are not intending to write back provisions, but will not be adding a significant amount during the second half of 2022. For the NIMs, management expects improvement in NIMs only in the later part of 2022, and they are expecting NIM to sustain the growth at 9 basis points each quarter and to reach an exit NIM of 1.9% by the end of 2022. For loans growth, management expects to see strong demand for loans as cross-border activities pick up. The ASEAN loans growth is expected to be higher with some slowdown in Singapore and North Asia. So UOB has guided for mid-single-digit loans growth for FY22. So I'll now touch upon the China exposure. UOB's mainland China exposure stands at the 24.8 billion or 5% of loan assets, of total assets, of which 8.2 is bank exposure and 12.6 billion is non-bank exposure. So the top 5 domestic banks and 3 policy banks account for about 70% of the total bank exposure, while non-bank exposures client base include top-tier state-owned enterprises, large local corporates, and the foreign investment enterprises. Management has mentioned that they have about 3 billion Sing dollars in loans to mainland Chinese developers, making up about 1% of group loans, with low borrower concentration, and they do not see any risk of it turning to NPL. As such, we maintain a buy with an unchanged target price of $35.70. Now moving on, I'll be covering on IFAST, Phillip on the ground, and this is their recent first half 22 results. So firstly, the second quarter assets under administration, or AUA, it declined 5.1% quarter on quarter to 17.68 billion, but it rose 0.8% year on year. So a broad decline in the value of investment products has offset the positive net inflows of client assets, which are 1.26 billion in the first half of 2022. For the revenue, the group's total net revenue, it grew 13.3% year on year to about 30 million. And even as the global financial markets have gone through a very difficult period. However, there was a net loss of 2.7 million in the second quarter. And this was mainly due to impairment allowance of 5.2 million from the restructuring of their India business. Now, to highlight that their recurring net revenue was actually up 6.7% year on year. And they have mentioned that in the last 2 years, there was some decline in the recurring income margin because of the lower interest rate environment, as their AUA was earning low to zero interest. However, the higher interest rate environment should improve their recurring fees. Now, they have declared an interim dividend of 1.1 cents for the second quarter, and this is unchanged year on year. They have also given new updates on their Hong Kong e-pension business targets. So just briefly, the net revenue for 2023 is expected to be more than 280 million Hong Kong dollars, more than 900 million Hong Kong dollars in 2024, and more than 1.3 billion Hong Kong dollars in 2025. So what this translates to is it is expected to add profits of more than 17 million Sing dollars in 2023, more than 44 million Sing dollars in 2024, and more than 88 million in Sing dollars in 2025. So that's all I have for the banking sector. I'll now hand it over to Terence.
Thanks, Helen, and good morning, everyone. Keppel Corporation announced their first half 22 results, along with a bolder statement to transform its business into an asset-light recurring income business model. So in our next slide, first half 22 net profit was below our expectations at 43% of full year 22 net profit forecast, but interim dividend of 15 cents exceeded our forecast of 12 cents. The net profit of $498 million was 66% higher on a year-on-year basis, though this was offset by the drag in the urban development business. So if you look at the table here on your left-hand side, you can see the urban development business results was slightly under because sales has fallen by more than 50% in China. One bright spot, however, is that the average selling prices have remained stable as the company is in key major cities. Because they are in key major cities, the prices are also a little bit more stable. Year to date, the company has also announced $710 million of assets that have been monetized, bringing their total assets monetized since October 2020 to $3.6 billion. The company remains on track to hit its $5 billion target by end 2023. Internally, when we look at this number, we also think that there's upside for this target. Should they be able to conclude their offshore and marine deal with Sembcorp Marine, they will cross the $5 billion target by the beginning of 2023. Last but not least, we welcome the bolder statements made on Keppel Land's transformation to be asset-light. To recap, in the past, Keppel Corporation has been, they've talked about how they want Keppel Land to be asset-light, but they haven't gave concrete plans in terms of how they want Keppel Land to be asset-light. But in this first half 2022, we were surprised that they actually made more substantive statements in terms of how they want to realize value from their assets in Keppel Land rather. So Keppel Land's transformation will be similar to Capital Land Limited or CLI, where they will crystallize the value of their land bank by moving this over to some of the Keppel owned funds and REITs that are listed. So this will allow them to realize the market value of their land bank and really crystallize this value. The value and the proceeds from the crystallization of these assets can then be reinvested into proceeds into new growth areas, and they will also share some of these gains with shareholders through dividends. In terms of the negatives, for Keppel, the headwinds in China property market continue to weigh on Keppel Land's China property sales. First half 2022 sales in China was already 69% lower on a year-on-year basis. The positive thing is we do not expect any impairments on their China property, mainly because most of their land bank is about 7 years old. So because the property was, most of the land bank was bought like 7 years ago, the cost on this property is also consequently much lower as compared to what the market value is today. So they don't expect any impairments for at least for financial year 22. In terms of segmental updates, the outlook for O&M remains positive. You can see on the table here on your left-hand side, the first half 22 energy and environment business actually reversed from the loss from last year, first half 21 loss of 179 million to a positive $109 million for this year. So this profit turnaround was driven by higher revenue from its O&M business and also Keppel Infrastructure business. Specifically, they also have been shortlisted as the only qualified bidder for the Petrobras PAT FPSO project. This project is worth $8 billion. So to put things in perspective, their first half 22 order book is $4.4 billion. So this should they be successful in bidding for this contract, then this will increase to 3 times for them for their total order book. What more specifically, we also want to highlight here that the being shortlisted as the only qualified bidder really highlights the technical competency that Keppel have over the rest of its peers. We know that some of its peers like Sembcorp Marine were also at the bidding table, but Keppel Corporation was the only one that was shortlisted. So one positive for Sembcorp Marine shareholders, obviously, if they vote for the deal, is that should Keppel Corporation win the Petrobras deal, and because it's the only qualified bidder now, then this contract will be subsumed under the new combined entity. So the Sembcorp Marine shareholders will also be able to take advantage of this deal. Moving on, infrastructure's renewables segment expanded to 1.8 gigawatt with their latest acquisition of a new wind power project in the Nordic countries. It remains on track to hit 7 gigawatts by 2030. So this is positive for the group because it furthers their ESG and green growth plans. Connectivity solutions also continue to grow due to the growth in data centers, and its asset management arm also it is expected to grow from strength to strength with a $200 billion target. We believe that this $200 billion target will be achieved by what we mentioned earlier on through the divestment of its sizable land bank into the Keppel owned managed funds. So the business model will become quite similar to the CLI business that we see now, which we think will lead to the next leg of re-rating for the group. In terms of outlook, in our next slide, preparations to complete the proposed O&M transactions are progressing well. Management remain hopeful on meeting the timeline for completion by the fourth quarter of this year. COM is also making encouraging progress with its legacy rigs and is confident these rigs can be substantially monetized over the next 3 to 5 years. Management disclosed that there are already buyers circling around the legacy rigs. We lower our revenue and earnings estimates for Keppel Land by 3% and 7% respectively on the worsening outlook in China's property market. In the second half of 2022 and financial year 23, they are expected to launch 895 and 2,644 units respectively, but we expect the response for these properties in China to remain muted on account of the current macroeconomic backdrop. In our last slide, we maintain our buy on Keppel with a higher sum of the parts target price of $8.95. This is up from our $7.07 previously. We revised our valuation on COM and Keppel Land with greater clarity on its monetization path. COM is still valued at 0.8 times, but the realizable value of its rigs was cranked up mainly because the clarity on this disposal is now clearer to us. The urban development segment also saw a discount, the discount on its valuation reduced to 35% from 40% previously to reflect better clarity on its monetization path. But we still apply a 20% HoldCo discount. As Keppel moves towards transforming its business to being asset-light, we expect the discount to narrow going forward. So that's all for me for Keppel. I'll now hand over the time to Sean.
Thanks, Terence. So I'll be going through the meeting's highlight that happened on the 27th of July last Wednesday. There is no dot plot graph this time around, as the graph is published every quarterly, so the next one will be in the September's meeting. In last Wednesday's meeting, the Federal Reserve has raised the federal fund rate by 75 basis points. This is the second 75 basis point hike this year to 2.25 to 2.5%. This is in line with what the Federal Reserve has guided in the previous meeting back in June. Though recently prices of some commodities have turned down, inflation still remained well above the rates of 2% as the consumer price index came in above expectation at 9.1% in June. This was mainly driven by the earlier surge in prices of crude oil and other commodities that was resulted from the Russia's war on Ukraine, which has created additional upward pressure on inflation. The US labor market has also remained extremely tight, with unemployment rate nearing a 50-year low at 3.6% in June, published by the Bureau of Labor Statistics. In terms of guidance, Chairman Powell did not mention any specific range as of this meeting. However, he has mentioned that he noticed recent indicators of spending and production have softened, but he and his colleague will be looking for compelling evidence over the coming months that indicates inflation is moving down before slowing the pace of the increases. Chairman Powell have also mentioned that another unusually large increase would be appropriate at the September's meeting, and this decision will be dependent on the data that will be published from now till then. Some notable comments that were mentioned by Chairman Powell, such as it is likely that their full effect has not been felt by the economy, and also we are strongly committed in bringing inflation back down to their 2% objective, signals that the economy shouldn't loosen up yet, as the aftershock of the recent rate hike has not fully taken effect. That's all for the FOMC meeting, and with that, I'd like to hand over the time to Paul to discuss about Sheng Siong's second quarter result and Singapore Weekly.
Yeah, thanks, Sean. So for Sheng Siong released their second quarter results, the title, what we're trying to say is that the sales is normalizing. So sales is declining back to pre-pandemic levels, but one positive is the exceptional margins they're enjoying. Next slide. So if you look at the results, the bullet point on the far right, the PATMI, that means the profits actually beat our expectations. Mainly was because gross margins surprised to a record 30%. This is the all-time high for gross margins. A year ago was close to 29%. So again, the positives. So the reason why margins are up is mainly because of the higher contribution of fresh food, which is your perishable, which is your fruit, seafood, poultry, and so forth. So despite food inflation, they managed to turn even more competitive. I think that's the only reason why you can sell more fresh and not pass on. So one of the reasons why they are competitive in their pricing is because one of the reasons given was they source directly from exporters. Some competitors might be taking from wholesalers. Secondly, the ability to reduce waste. So what this means is that fresh food, because of the short shelf life, there's usually a bit of wastage, but they try to resell it, repackage it, either cheaper and so forth. And there's also tactical purchasing, which is a bit new for me because when the pandemic hit, a lot of deliveries couldn't. When the lockdowns happened in China, there were some deliveries that could not be shipped to China, so they managed to take advantage of that and divert the shipment to Singapore. So this is what they do sometimes because they got a very active sourcing team. The other positive was that the store count resumed. So during the pandemic 2020 and even 2021, there was virtually no new stores. So right now they have guided that there'll be 3 to 5 new stores to add on to their current footprint of 66 every year for the next 3 to 5 years. They've secured 3 stores this year, and there will be another 4 more pending bidding stage. It doesn't mean they get all 4, but at least there's some. The HDB is open up stores for bidding at least. The negative is same store sales contracted. So what this means is that as we're coming out from the pandemic, there will be less dining at home. So this will kind of normalize a bit the revenue trends. It's the first decline that we've seen since the pandemic. So in terms of our outlook, it's a transition year because grocery demand will normalize. But what we think can kind of offset the decline, we are still forecasting a decline in earnings, but what can at least stem the weakness will be new stores, rising market share, especially taking share from wet markets, and also improving gross margins. In terms of how many more stores they can open, just to give some flavor, they have only 66 stores. They could actually, there's runway for them to even double the footprint because their largest competitor in Singapore, I guess we know who is NTUC, has I think around 230 stores. Even the next competitor, like I think Cold Storage or Giant, they have I think about 100 stores. So there is room for them to grow the number of stores. We lifted our earnings because of the higher target price and higher margins, and we also lifted our target price. Next slide. Next slide. So let's go through the key macro events for Singapore. So we had our inflation reading here in Singapore. It is now actually higher than the MAS projection of 3 to 4%. So I mean, if this keeps on going, there is a risk. I mean, that the MAS might tighten even more. That means push the exchange rate even higher. Especially now, especially when we come to the October. MAS normally does monetary policy in April and October, so you could see them maybe not sure, maybe tightening a little bit more or not. But that's a possibility. We had quite a bit of healthcare data. They all came only a few days ago, but so for June, we saw dental attendance spike up quite strongly, 22%. It's the rebound since the relaxation of social restriction. I guess now that the restrictions are open up, people are more open to coming to clinics and not get worried they get infected. We also saw private hospitals. That's why Raffles Medical did not just release very strong good results, 10% up, and is recovering very strongly from the May 0.7% year-on-year increase. So what has happened is that what is driving all the admissions is firstly foreign patients, especially Indonesians that are coming back. Secondly is electives. I think electives is mainly the local patients, so especially for the elderly, there could be elective surgeries that they could do, maybe like a knee replacement and so forth, but they may not do it because of the lockdowns, because of worry of COVID. So they're beginning to see all this coming back to the private hospitals. The data from the US was another inflation read. This is it's also inflation, but it's not the usual CPI we see. It's called PCE, which is a broader definition. But this is the one which the Federal Reserve uses to do their 2% targeting. It continues to expand, and it rose about 0.7% month-on-month. Why we are talking month-on-month is because if you just do some mathematics behind it, is that if there is no increase month-on-month for the CPI or inflation, you probably need at least 6 to 7 months before it kind of reach 2% year on year or the Fed target. So what we're basically saying is that right now the inflation rate is still rising because it's up month on month, right? But for it to stabilize, you need it to be at least flat, and even if it goes flat, you need at least 6 to 7 months before it goes down. So any indications of a softening inflation rate, you need to at least see some month on month numbers. In terms of the FOMC, like Sean mentioned, so I guess the key thing we were watching is the market seems to think that the Federal Reserve is pivoting. So I mean, we just wanted to see what were the comments made by Powell to suggest that. So I think one of the key things he said was right now the current Fed funds rate, which is 2.25, is within, they think he thinks that it is neutral. So this is a bit surprising. We thought neutral would be higher. And he also said that they will go moderately restrictive. That means they'll tighten a little bit away from their neutral to 3 to 3.5% by year end. And also, like mentioned by Sean, the other thing why the market read, why they think that the Federal Reserve might be at least softening their stance to raise rates is that he said that the full effect hasn't been felt yet. So all these comments made the market believe that maybe Fed is pivoting. That means it's not going to tighten as much as possible. So in just our tactical view, we think it's still early to flash V-sign victory over inflation. So what we need to see is at least month on month, inflation starts to turn flat or negative. Then at least we will have some visibility that the inflation will start to peak or at least come close to their target. At least there's some visibility of the target. But nevertheless, I think the near-term sentiment of the market is bullish, because there was all kinds of bad news, but the market still continue to rally. So the price action suggests that this rally could continue. Why we say that is that even though there was a 75 basis point hike in interest rates, US corporate results was a bit shaky, some good, some really bad. There is a US GDP was actually suggests that the US is actually in a technical recession. The Russians cut gas, but the market still rallied. So it just shows that you can throw all kind of bad news, but the market is still running. So the price action suggests that there could be a short-term rally underway. The next important one is probably the employment numbers coming on the 5th. That means on Friday. Any weak numbers could actually be read positively. That means that the Fed could be slowing down the rate hikes. But anyway. So in terms of some of the key events, Wednesday we have OCBC, on Thursday we have DBS and Wilmar, and then Friday we have Venture. These are some of the main corporate results. For this week in green will be some of our webinars. So if you have time, feel free to register. It's open to anyone. We have SETS Prime and also Penn United. Next slide. So this is just an illustration of the big jump. So in rate, which is more important for us because these are the listed companies. So you can see that the emissions in rate has started up very sharply. I mean, they were contracting, they bounced back mainly because of the foreign tourists and elective surgery. Dental attendances is higher than the red line, which is the 2021. So it shows that there's the last 2 months saw a big jump, because before that you can see that sorry, the internet's a bit my connection's a bit unstable. Sorry. Before that you can see that the red line was actually higher. That means 2022 attendances to dentists were actually lower. Next slide. Yeah, sorry for the connection. Okay, so right now what the market is pricing in is that by December, the Fed funds is, because this is not the lower bound, this is the midpoint, is 3.3. So what this means is that the market is only expecting another 100 basis point hike in interest rates for the next 3 meetings. I think, sorry, next 2 meetings. There's one more three in September, November, December, I think. Yeah, but anyway, yeah, and then they think that by end of next year, the Fed will start cutting rates. So most likely the market is expecting rates to peak by end of this year. I think it's a bit aggressive, but I think that's what the market is factoring right now. Just for everyone's info. The table on the right is just the inflation rate. It's starting to pick back up again. The key is for us is at least the beige numbers. I think month on month, if it starts to decline or contract, then I think there's good sign that the inflation is really peaking. Next slide. Okay, I'll just go through three Phillip on the ground. We don't have coverage. So Suntec REIT released their results. Their DPU was exceptionally strong, was up 16%. Because I think because of the reopening. They also had a bit of capital distribution inside as well, so that so a little bit of capital distribution. So in terms of the comments coming out from Suntec is that the office market is very strong. I think most of the office REITs all say that because there's basically limited supply, and also they see a lot of big tech demand. So even though there's a bit of tech slowdown, I mean the market is worried that the tech companies might actually cut headcount, but it doesn't seem to suggest so in Singapore. So Amazon, they doubling their space in Singapore from 225 to 300. TikTok is tripling their space. They have 200 square feet in Singapore, but now they're looking for an additional 400. So the big tech is coming to Singapore for more office space, and that's helping demand. The other interesting thing was that he said that what's happening for Suntec is that there's a nice cluster coming up. So because Guaco Midtown is coming up, then they have South Beach Duo, Shore Tower renovation, rejuvenation, or however you call it. You come up by 2025. So there's going to be a cluster of offices here, and this would kind of uplift the whole activity in this area, because there's so many big developments happening within this Suntec area. In terms of conventions, pre-pandemic they had 900 conventions. First half they had 300, so they do see a recovery in the conventions, but they're all smaller scale. So you need more volume to pick up, because the convention size now are much smaller than in the past, but at least the volume is picking up. So in terms of outlook, this stock looks cheap, I guess, because it's trading below the NAV of $2. And then you do see recovery in retail, convention, and so forth. So I guess it looks cheap in that sense. Next slide. In terms of the OUE commercial, so it's a bit more complicated. So for OUE commercial, they are integrated REIT. They have office, hospitality, and retail. So the DPU also did well. So the yield is also something like Suntec is about 5% plus. They have an office in Shanghai, although it's very small contribution, but they had to give out rent rebate because of the lockdown. The worst were the retail tenants, because basically there's nobody out there, there's nobody going to any retail shops. So the big one that they highlighted was Hilton Singapore, which is I think the biggest hotel in the biggest Hilton in the region, with 1,000 rooms. So now they only have 600 rooms. But the problem is, it's not so much they want to open, but just can't have, just insufficient staff. So, but the RevPAR is very strong. It tripled year on year, and also because some hotels in Orchard Road are doing refurbishment. So the one thing they get when they open Hilton is that they are getting more US and European guests, which they didn't have under the old Mandarin. Is it Mandarin? Yeah, under the old hotel. There are a bit of income support issues here. So they have income support for OUE downtown, which you look at the table on the bottom, is about 20% of all their rent. But the income support is fully been used. So they're good. So second half, this is going to be a drag. So they won't have income support for OUE downtown. And then they can't get the rentals above $9. To cover the income support, they need like rent above $9, which they can't get. OUE Bayfront is doing well, but they want to just raise the rent to $17. This stock is also trading like Suntec, trading below NAV, but I think it's going to be a bit challenging for second half because they don't have the income support. And without this income support, your DPU will have a 13% downward pressure. So you need the other parts to do really well, especially hotel. But even hotel is also getting income support. So I think there's a risk that DPU might actually drop for OUE because they don't have the downtown, I think 8 million contribution, which is huge considering the amount distributed is 60 million. Next slide. So this is the last one for me. Sorry, second last, before we go to the model portfolio. So Hutchison Port Trust. So Hutchison is actually a business trust, and they own mainly ports, container ports in China, which is 2/3 of the revenue all come from China. And they have ports in Hong Kong. So the PATMI was down, but the cash flow was still very strong. So the cash flow was about 300 million in the first half. The DPU was flat at 6.5 cents, giving them a yield, I think it's about almost 8% right now. But they because they actually can pay much more. I mean, I'll elaborate later. So one of the reasons is that they are paying down debt. So just as a reminder, when you are a business trust, you actually, when you pay debt, it's also considered, it will be a deduction in your distributable income. No? Not like REITs. REITs, you pay down debt, it doesn't affect your distribution, but for business trust, it will affect your distribution. So what they're doing is they just continue to pay down debt. So that's why their finance costs didn't go up. They're in China ports, they're benefiting from raising rates, tariffs, but Hong Kong, they cannot raise tariffs because of the lockdown. The border is shut, so they cannot get all those cargo from China to go through there's no hinterland cargo. Hinterland means your local domestic economy cargo. So in terms of the outlook, this stock also looks quite interesting because it's trading below the book of 40 cents. The dividend yield is 8%. But if you look at the real free cash flow yield, that means if they just pay out whatever cash they generated, the yield is actually much 30%. Just that they're using a lot of the money to just pay par down debt. So they have a huge buffer to cover this 8% yield. But again, because the container, so the volumes might be impacted. But I guess probably the worst is over because because there's been a lockdown in China. What has been helping the revenue is the storage income, but they don't disclose. Okay, next slide. Just the last few for me. So this is our model portfolio. We will flash it out every month. We were only up 0.7 compared to the market. You can see from the table on the right so STI was up 3.5% in July. It actually basically covered back all the losses in June. What dragged us down was the mid caps like PayTV and also Del Monte, and also City Development. What did well were all the large caps like DBS and OCBC and also Singtel and also Keppel Corp. Next slide. So in terms of this, is just for illustration on what did well. So banks did well. Again, they rebounded after losing last month. Industrials and again, all this is just for a reference. I think the reopening stocks did well. If you look at the STI gainers, like Genting Singapore rebounded, SIA rebounded, and the cyclical names are like the banks, venture, everything all rebounded. Okay, next slide. I think that should be the last one. Okay, sorry, this is the last one. We just for everyone's info, what assets did well. So of course, Nasdaq did very well in July. It's up 12%. Gold was down, and commodities also rebounded. Singapore did well. I mean, it was up, I guess, reasonably well at 4%. We actually beat the MSCI, which is the Asia ex Japan, which was down because I guess it's dragged down by a lot of the Chinese tech names. This is all in US dollar terms. Okay, I think that's it. Thanks, just for everyone's information.
I'll take one of the questions. Someone asked, does the UOB second quarter results meet or miss your house expectation? Yeah, I mentioned earlier. So actually their second quarter earnings of 1.1 billion were in line with our estimates, and mainly due to the higher net interest margin and healthy net interest income growth. So the first half 22 PATMI is currently at 43% of our FY22 forecast. So I hope that answers your question. So that's all I have for the banks. I'll hand it over to the rest of my colleagues. Thanks.
Yeah, can you take some? I can't see the earlier questions. Can you just take?
Paul, that's all the questions that are there.
Okay, sure. Thanks. So let's move on. Paul, what is your time frame for Sheng Siong? Yeah, usually our target price is usually 12 months. We usually just do a 12-month rolling target price. Could the price action due to flowing out of funds out of China? I don't think so. No? I think if you look at the MSCI World Index, I don't think China is such a huge part. Sorry, I don't have the numbers here, but I doubt it. My guess could be some short covering too. That also is a big driver, and no, the market, I think if you look at the Nasdaq is, I don't know, down 20%, is it, or 15%? Yeah. So I don't think it is China. China from the MSCI world contribution isn't that much. You mentioned, Paul, you mentioned dental attendance increase. How do you see? Yeah, I think this is obviously very positive for Q&M. But it's just that the headline numbers won't be that great. The reason is just that we're not sure how the market's going to react, because Q&M did very well because they had PCR contribution, the COVID-19 PCR test. But it depends how the market want to see it, because the core dental will do very well, because if you're getting, the industry is going up, number one, and they are also expanding their clinic chain by 12-13%. So they will get some good numbers from the core dental. Because again, the industry is up, and then they are taking market share because they are aggressively rolling out more clinics. Yeah, thanks for that. So you think the revenue rally is sustainable? Yeah, week to week commentary is more like trying to outguess the other people guessing about. But we think it looks sustainable because so much bad news, and the market can still run. So I think it will run until maybe when we get the next inflation read, if there are no surprises, and there's a good chance the headline CPI might actually start to dip because commodity prices drop down so much, right? So if the CPI inflation number, because that's the most important indicator now, inflation, if that maybe slightly tails off a bit, well, then I think the market could rally even more. Yeah, that's my own thoughts. Yeah, because almost every imaginable bad news came out, but still the market kind of already priced in quite a bit of it. Why is there a sell down on Asian pay TV or selected? Yeah, I'm not particularly sure why there was any sell down. Yeah, but we still keep it. For us, it's just a dividend yield, a stable dividend yield. We collect like 8%, which we don't dividend yield we don't put into our performance because we just kind of just say that it's part of the broking cost or whatever. But yeah, but we still will leave it there until we find because we think that the 8% dividend yield that they pay can be supported, even though higher interest rates, because they got 60 million cash flow versus 20 million dividends. So we think more than enough to cover. Yeah. But I can understand maybe the market is a bit wary because of the hard interest rates and so forth. Any views on venture? I think yeah, we think venture should do well too because of the whole supply chain. And also, last year there was also still disruption, especially in Malaysia. So year on year, the comparables should look very strong. Something like what we saw in Aztec. So Aztec also, I mean, there are not many contract manufacturers left in Singapore. So Aztec Global, although I didn't really go attend because the briefing, but the Aztec numbers is also very good, and partly because the supply chain has been slightly improving. And because venture isn't so much into PCs, into laptops, they're more into healthcare and so forth, right? So that might do a bit better. Yeah. The other one that should do well is also some of the UMS and AEM, because the UN decided to subsidize. There's a 280 but anyway. And then you can imagine what you can imagine what China will respond now that China sees that the US is building up capacity. Then there might be a strategic race to build more semiconductor. Of course, the longer term isn't so great. There'll be oversupply, but probably like a 2-3 year thing to worry about. Okay, Glenn, you want to go ahead first?
Yep. So there's one about for UOB, the risk related to the legal case against Shimao is covered. So i.e. including in its current provisions. Have you seen any details of this case? Yeah, so for this case, the UOB has, during the call, quite a few questions were raised, but UOB declined to comment on most of almost all of the questions saying that they can't really release any details on the case, and it's still ongoing. So, however, what they have mentioned, what they could say was that they have about 3 billion Sing dollars in loans to mainland Chinese developers. So this makes up about 1% of their group loans. But they have said that this 3 billion, it has low borrower concentration, and they do not see any risk of it turning to NPL. So yeah, that's all I can actually mention about this the Sheng Siong case regarding UOB. Let me look through. Okay, there's one about Chinese banks. Sorry, we don't cover Chinese banks, so it's a bit hard to comment on this. Yeah. Okay, I'll hand you over to the rest of my colleagues. Thanks.
Yep. Okay. Let me see. What's your take on the Thai Bev Beer Co IPO? When we did the numbers the last time, depending how you want to put the valuations, I think Thai Bev want to value at around 30, 40 times PE. But our back of envelope calculation, it will only help Thai Bev maybe 3 to 4 percentage in points in the earnings per share, because it will just save on the interest expense. It's hard to give an exact number because depending on the valuations, but we're not particularly excited about it because what they are listing is basically Sabeco, which is in Vietnam, which is already listed anyway. And also they are listing their Chang beer in Thailand, which is, I mean, not the most exciting growth for Thai in terms of the whole business. And the 80% of the profits still come from or almost 90% or sometimes comes from the spirits business. So we're not that excited for the beer co, maybe because you can already get exposure to the Thai beverage beer business through Vietnam. So unless, yeah, so I'm not that particularly excited about it. It's a deleveraging. It's mainly to deleverage the after they acquired Sabeco a couple of years ago. Views on Singtel. So we are still positive on Singtel. I think the reopening should help. The reopening should be a positive for Singapore and Australia business, and the overall improvement in the regional countries, emerging markets. So that's why we still like. Sorry to keep repeating this, but they are very exposed to emerging countries like Indonesia and India, where prepaid is a discretionary item to a certain extent, a prepaid phone. So that's why we think there's a big tailwind for them. And in the background, they're also doing a bit of restructuring. Of course, they're also acquiring some weird assets, but in the bigger scheme of things, they are also on the monetization path, and they also sold off some of their problematic assets. So in the general broad sense, I think we are positive on it. What are your views on Vilma next 12 months? Yeah, I think Vilma should be positive. I think we are positive on we don't cover Vilma, but we think like what was mentioned, some of the most interesting stocks for the quarter. I think Vilma should be interesting because almost all the business is going to do well because they raise prices in China for their edible oil. The crushing margins are recovering because the hog prices are improving in China, and also the processing should do well because because they are processors. So when the palm oil price is down, it actually benefits them because their plantation exposure isn't so much. So we think next 12 months, Vilma should do better, should be performing well because most of the business is doing well. Please suggest 3 predominantly European REITs listed where to find their target price. Yeah, Darren, I'm not sure if you can help. Okay. Hi Paul, what are the most interesting stocks this quarter? I think probably Vilma, Genting, Singapore, maybe UMS and AEM. I think they do perform strongly. After all, they did correct due to the recent Nasdaq sell down. Yeah, so I think these are some of the names, and Genting I think should have a good dividend announcement. We think, we guess, no, this, yeah. So these are some of the names we think could be interesting this quarter. Yeah, Darren, you want to help on this Keppel Prime and all that?
Oh, I think Darren's at lunch.
Oh yeah, sorry. Yeah, apologize. Yeah, Darren, our new REIT analyst. Yeah, he's at the first REIT lunch. Oh, sorry for that. After this report season is over, are you expecting a cyclical clip towards are you expecting cyclical dip or towards the downtrend? I think yeah, there could be, but it seems I think cyclically things should slow down. I think most of the indicators are showing some slowdown, but the interesting thing is the market really kind of priced this in. I think this recession worry is like probably fact out. I don't know how many times in the press. So even though things slow down, I think the market has kind of very priced in a lot of this. After all, US is on paper in recession. I mean, but of course that recession is a bigger definition. But they did experience 2 quarter-on-quarter decline. So I think even if the numbers slow down a bit, the market is already kind of priced that in. So I'm not sure if that kind of helps you. But definitely should be slower. I think globally all the indicators are turning downwards. Raffles Medical reported good set of results. Any thoughts on the other overall? Yeah, okay. So I just finished my Raffles Medical analyst briefing. They need to do one every 6 months. Like what we highlighted, it was mainly because of foreign tourists coming in. So the reason we thought without COVID, we thought that the earnings might actually weaken, but actually it jumped up 50%. It blew past our forecast, but my forecast at least, which was wrong. Our forecast is obviously wrong, but so I think they got a big pickup, like the chart earlier shows. May and June, a lot of foreign tourists came in, and you're also seeing it in July because it's not going to be only 1-2 months and nobody comes. So we think the momentum could continue into the third quarter. So I think most of the medical stocks should benefit because it is not only so the 3 parts here for the first. Foreign tourists came back. Number 2 is also number 2 is the elective surgery, the local, and also the GP clinics also did very well. So a lot of people returned to the GP clinics because in the past nobody wanted to go clinic, right? I mean, you afraid you contract something else, and also with less mask on. There seems our normal cough and cold ailment seems to return back to normal. So a lot of the GP clinics. So I think one way to test it, I think you try to go to the specialist and make an appointment. I think everything is full. I think so. I think all the other medical like SMG should also do well because SMG also has dental. They have aesthetics. Aesthetic, I guess a bit more stable, but they have a lot of lab equipment, diagnostics. Laboratories also very full. So I think SMG should do well in that sense. Yeah. Because the other thing that's also full is you try and do diagnosis, you're going to do a health check, everything is full these days. Is the supply chain disruption story over and tech stocks are coming back? I wouldn't say completely over, but it is definitely improving. Yeah. So we think contract manufacturers should be healthier because I think for venture, they always said that the orders were strong. That means they had a lot of orders, but they just can't fulfill because there was so many disruption. Although they benefited a bit. What they did was because they got such a strong net cash balance sheet, they just mop up all the inventory. So yeah, but that's why we think. I think contract manufacturers should do well. That's why we saw a bit of it in Aztec's results. What's the upside for paper? Ambrish, I'm not sure if you can help on this paper, although we don't have coverage.
Yeah, sure, Paul. So for PayPal, what is the upside for PayPal to rally back to US dollars 250 plus and above? So basically, we don't cover PayPal, but in my personal opinion, I believe that the business is good. The company's total payments transaction volumes, it has been increasing almost by 30 to 33% range, and continuously over the last 2 to 3 years, and it has reached to about 1.3 trillion right now. And the company should benefit from e-commerce transactions, which has been rapidly growing, as well as the money transfers, online money transfers, and it is one of the preferred digital wallet payment option as well. So yeah, I think that it has a good outlook right now. Over to you, Paul. Thank you.
Terence, you take the Sembcorp. Thanks. Yeah, thanks, Amrish.
Yeah, sure, Paul. I'll take the Sembcorp question. Any outlook for Sembcorp Industries with their results coming out this Friday? Yeah, so we recently revised our revenue and earnings for Sembcorp Industries. We believe their conventional energy segment will grow very strongly in the first half of 2022, and we also expect their renewable energy to also increase. So on the back of these two factors, we raised our profit by 6% for full year 2022. The first reason for that is because conventional energy is expected to be lifted up by higher USEP prices and tariff prices in Singapore and India respectively. Their renewables installed capacity is also higher on a year-on-year basis for financial year 22. So overall, we expect their results to come ahead of the market expectations this Friday. I think that's all the questions I have. I'll hand it back to Paul.
Yeah, thanks. Views on Genting Singapore. Yeah, I think we answered it earlier. We're expecting some good dividend, or at least a strong dividend policy, and the results coming out from their competitor, Marina Bay Sands, also showed some very good numbers. Yeah, I wanted to do a chart on Marina, but it just didn't have the time. Yeah, sorry for that. Yeah, but I think the results should be also similarly strong. Any views on UniAsia and LHN Logistics? For UniAsia, we think the results should be strong too. The first quarter, when they gave the update, the freight rates were up, I think 80% year on year. So I think it's a bit down in the second quarter. I think a bit, or the growth not as high year on year, but we think overall first half should have some very strong numbers for UniAsia. LHN Logistics, I think this one it will probably take next year. I think because they are still setting up the new container. Sorry, not container. The new facility to service all those dangerous goods or the chemical containers. So I think that is more a story for next year for LHN Logistics. Until that is up, which is only up this year, sorry. But it will take at least 1 year for the revenue to contribute and so forth. So that one might take a little bit longer, I think. But I think in the meantime, they mentioned they're going to pay some attractive dividends, yeah, from my recollection. Please suggest 3 predominant European REITs listed on SGX, where to find it. Yeah, for this one, can you send us an email? I don't have it offhand. I don't think we cover any specific European REITs on SGX. Yeah. You send us an email, we will try to get you the data. Just that I don't have it. We can get it off from Bloomberg. I mean, Bloomberg also has target price by analysts, so we can give you that, but you have to send us an email. I don't have it offhand. Any comment on HR Hourglass? We don't cover Hourglass, but if you look at the May data, which I was checking just now, I think in May, watches and I mean, I don't know who's buying all this, but in Singapore, watches demand jumped 60% in May. In April, it was up almost 30%. So there's a very strong demand for watches the last 2 months. Okay, it's obviously not me, but but the demand has really spiked up recently. For HRNet, we think the results should also be strong. I mean, in view of the whole market environment. Yeah. The only thing is probably the focus will be a bit more on China, how the lockdown affected them and so forth. But in terms of for Singapore, it should be a growth year because again, there's a shortage of workers and employers are relying more on recruitment agencies to hire. So, given Keppel or Pacific, what's your read on Manulife? Yeah, sorry, I have to defer this question because I didn't attend the briefing and Darren is not in. So I think again, sorry for the read question because he's not in. So you send us an email, we will try our best to help you. Or you can just put the question in our P3 community app. So for that, we can't escape. We have to try and answer here. So that's an easier way to get some questions. Yeah. in P3 we have a community group called the Singapore Research, so you can type questions there and we'll try and get back to you. With developers quite bullish on office rental, but local REITs did not even move much. Any reason? I think, yeah, like we highlighted, although it is up, the three things pressurizing them is basically the higher interest rates. I think any REIT in general, because some hedge, like we discussed the last year, I think to maintain dividends, a REIT in general needs to probably raise their earnings or MPI and net property income by probably 6 to 7% a year, roughly. Because some of them are hedged, you don't feel it now. But if you get the full interest rate impact filtered through, they need to actually grow their income by 6-7% a year just to maintain dividends. So that's why I think it will take a bit of time for REITs, because I don't think most of them don't even grow so much. I think most REITs grow maybe 3-5% organically without acquisition. So that's why I think it's going to be hard to grow their dividends organically when interest rates get filtered out. You won't see this impact of higher interest rates in the next 1 year because they hedge. Because most of them fix their interest rates, so they keep paying the low interest rates. But after 1 year, then you begin to see the impact. So I think that's why the market is a bit hesitant to go and chase after REITs. But that's my own view. What's your view on oil and commodities? Have they peaked? I think industrial commodities might have peaked in the near term, but oil is a bit difficult because the problem is China. If China reopens, I'm not sure how much the commodity prices are going to spike. The real test is once the news of China reopening, if the commodity price don't move, the price action for the commodities don't move, then I guess they kind of peak. But until you get this reopening of China, really not truly clear whether they peak. Yeah. Especially with oil, right? If there's one bad winter is very cold or something, and then you might get another big jump, and they're going to ban, Europe's going to ban Russian coal by end of this, Russian oil, sorry, by end of this year. So again, it's a bit early to say whether they peak. I mean, basically, I'm not sure until I see the China thing news, the reopening of China. Yeah. Why the recent hike price? I'm really a bit puzzled too myself. I think because although you can argue that the recent launch the higher prices can help commission income, because commissions is based on price also, but the volumes are down too much. I still expect weak earnings from Propnex and APEC. The one that benefits from higher price is the developers. It's not so much the real estate agents. Paul, Raffles Medical, any comments on its China hospitals? Need longer gestation? Yeah, I was a bit surprised. It's okay. So for China, just to give everyone a background, because Raffles Medical, the interesting part is China, because Singapore is a bit matured. So they got hospitals in Chongqing and hospital in Shanghai. They seem to suggest that the Chongqing, the volumes have been picking up because it takes time for people to know about them, the hospitals, because people only go to government hospitals. So what they're saying is that the volumes are picking up in Chongqing. Shanghai is affected because Shanghai of the lockdown, right? Although it's only 6 months old, the hospital was open, but I mean nobody can come, right? And they can't even get any staff. All the staff is stuck at home because they cannot leave the house. So I don't think it will need longer time. I think it was a bit more positive than I thought, the hospitals, and they also have this IVF in China. So in Hainan, so Hainan is setting up this special zone where they can do IVF, in vitro fertilization for those. Maybe what they mentioned was some young couples, they want to have, maybe in their 20s they have a kid, then now they in the 40s they want to have a children too, so they can't do it, so they need to have the IVF. And in this area, they could even offer cancer facilities. It's like a test bed. Why Hainan? Because Hainan want to invite tourism. They want tourism, so they want domestic tourists. These people from China, they come to Hainan. They can get all these treatments that they can't get elsewhere in China, like IVF or even cancer treatment using foreign drugs. You can get cancer treatment in China using local drugs, but foreign drugs you can't get it. So it's like a special economic zone or healthcare zone, I guess. So I don't think the losses might might widen. I think it's within their 10 million loss EBITDA loss per year. Yeah, so that's a very long answer to a short question. Outlook for CDL. I think this one you can ask. I think Terence can help the CDL question. GX and also
Yeah, Paul. So I'll take the question on city development. The outlook for city development. The outlook for city development remains positive. For the first half of 2022, they launched the property Piccadilly Grand, and that was more than 80% sold at an average selling price of about 2,005 per square feet. So that highlights the strong demand for property, still for the property market, because the Piccadilly Grand is actually considered an OCR region, and even in the OCR region, they were still able to get such a strong response. When we look at some of the more recent property launches in the market, like Amore Residences, which was launched in Ang Mo Kio, that was 98% sold after 2 weeks after its launch. So we think the pent up demand for property remains strong, despite the heightened cooling measures that we put in place, and also one of the other factor that we think will lift profits for the second half of 2022 is the redevelopment of their CBD, the CBD redevelopment of the AXA Tower. So the redevelopment of AXA Tower will see them have a profit margin lift, and the reason is because they are actually only paying a very small sum to top up. They don't review how much, but it's likely to be just a very small sum to top up on the development. So the rest is just profit. So when they launch the AXA Tower redevelopment project in the second half of 2022, we expect the profits to be uplifted. So property development wing is doing well. The second wing is the hospitality wing, and that in almost all of their key markets, they have seen a double-digit growth, about 33 to 40% growth on average in the hospitality segment. That's been doing well because of the reduction of travel borders globally. So in total, we expect both of these factors to drive city development's profits for 2022. Yeah, that's all for me. I'll hand back the time to Paul.
Glenn, you want to try SGX?
Yeah. I'll take the one on SGX. So for any take on SGX, so SGX, I mean, there's two things. Firstly, that they are mainly investing for the medium term. So according to your last results, they have guided for FY22 expenses of about mid 500 million, and this is indicative of an 8.6% increase from FY21. So more than 50% of this increase will actually be for the near-term investments, and they include setting up their FX ECN, climate-related initiatives, and of course their continued investments into the BidFX and Scientific Beta. But they have also included in this guidance the expenses for Max Trader. So the second point would be that the rising interest rates would also benefit SGX. So apart from the banks, SGX is another beneficiary of higher interest rates. And as at the second half of 2021, they have reported a $12 billion float from collateral and $72 million of interest income. So this represents 13% of their FY21 operating profit. So, with the increasing interest rates, they would earn more interest from their float, assuming the float maintains the same level. So we should see an uptick in their interest income, which would flow down to their operating profit. So we just have to keep a lookout for their results, which is coming quite soon. I think it's in the middle of the month. Then we will see it from there. I think I'll hand it over back to you, Paul. Thanks.
Thanks. So for LHN, no real updates, but operation. But for LHN, for those who don't know, the key growth driver will be the co-living business. which is in between renting apartment and staying in the hotel. No, hotel is like 1 day stay, then if you rent a place these days, Singapore, probably like you take like at least a 1 year. So co-living is in between. And the business, we think it will still do well because the rental market is still very strong. And then right now you have foreign, with the borders opening, foreigners should come back in. So we think their growth trajectory will still do well. What has held them back was because they did some COVID-19 related foreign worker dorm. So that business went away. So that kind of pulled down the first half numbers. But for the full year, the key growth driver will be the co-living, which I think they got like 1,000 rooms or something. Yeah, just that I don't have the exact number because our analyst even has left us. For Fortress Minerals, from the last meeting we had, which is I think maybe a month ago, production should double. If production don't double, then you definitely have to cancel. That means there's something wrong with the mine because they just opened up a new mine, which is probably the production should be equivalent to the old mine. No, maybe it takes maybe 2 or 3 more quarters. The only thing is just we're not sure of the prices. I know that one is the direction of iron ore price. The one is like hazardous to guess, but in terms of volumes and costs, they will definitely be very strong because they got a new mine, and this new mine for Fortress is a very low cost mine. Because I think like we highlighted before, the old mines, you virtually had to take a big boulder and crush it down to powder form. But this mine that they had, this new mine, I think it's in Pahang, if I'm not mistaken, is basically you're just digging from the soil because nature has already crushed everything. So they really do very little processing. They virtually just dig it from the ground. It's basically topsoil. So that's why the cost is going to be very low for the next 3 to I think almost 3 years for this particular mine. So they should do well, but again, it's just the direction of iron ore price that you have to take. That is your risk. But for cost and production, they should do should be good. What's the runway PhillipCapital expects? All our target price across the board is rolling 12 months. If you think about it, we can't do 3 months, 6 months, it's a bit too short. Then in the end, it becomes like a technical or chartist report already. So that's why we normally just do a 12 months. Yeah. What's the target for Comfort? I think our target price for Comfort is 180. Any views on CDL? There was no briefing, but they definitely all the hotels in Singapore better do well because, like mentioned in OUE, their RevPAR, that means their revenues, short form for revenue, has tripled. In Singapore, the industry RevPAR is I think up 60%. So most of these most of the hotels in Singapore should do exceptionally well. The occupancy is still low, I think 60-70%, but the room rates is even higher than pre-pandemic. So that's the situation now for hotels in Singapore. In part also because there are still hospitals, they are still being used by the government. So a bit of the capacity is being still allocated to government. Probably until the year end, then the government might review. So supply is very thin now for hotels. And even any increase in supply is probably less than 1%. Yeah. Any view on hotels properties? Yeah, actually that's an interesting one. We're not really sure. I think we don't really look at it. Yeah. My only guess is if hotel properties have got some assets they can inject into the REIT. I'm not sure if there's any retail assets, but that's the only thing. But again, we never look at hotel properties a day. Yeah. So sorry, not much to value add for that. Yeah. But that's something that maybe we have to look at. Yeah. Thanks for that. So with that, I'd like to thank everyone. If you do have time now, do sign up for our webinars. I think we have three webinars this week. So if it's just go to our website, Poem's website, and you can just sign on. It's open to everyone. So with that, I'd like to thank everybody for your time and wish you have a very good week ahead. Thank you, everybody.